Okay, let's dig into one of the most explosive stocks in the whole AI boom, Nebius Group, ticker NBIS. Now, this is a company with a fascinating story. On one hand, you have absolutely incredible growth, but on the other, you've got these staggering costs. So the big question we're trying to answer today is, which side is going to win? I mean, just look at this number. Since it started trading in late 2024, NIBE stock has been on an absolute tear. We're talking a surge of over 520%. A jump like that, well, it doesn't just turn heads, it forces you to ask some pretty serious questions.
And yeah, here's the catch. Because while the stock price is just flying high, the company itself is reporting these massive losses. And oh yeah, it's also facing off against some of the biggest names in tech. So that brings us to the central question for today. Is this all real or is it just hype? Let's dig in and find out.
All right, here's the game plan for how we're going to break this all down. First, we'll cover what Nebius actually does. Then we'll get into the crazy revenue numbers and the high costs behind them. After that, we'll check its financial health, look at the road ahead, and finally, we'll wrap it all up with our investment thesis.
Okay, section 1. Let's start with the basics. What exactly does Nebius do? What's the business model here?
You know, the easiest way to think about Nebius is like this. They're basically a digital landlord for the entire AI world. Right? They build these absolutely massive, cutting-edge data centers, stuff them full of powerful GPUs, and then they rent out all that computing power to companies who desperately need it to train and run their AI models. But, you know, it's actually a bit more than just being a landlord. Their core business, for sure, is that AI infrastructure, that full-stack cloud platform. But they also run a Ride, which is working on self-driving tech for things like robotaxis. Then there's 1010, an edtech platform. And on top of all that, they hold major stakes in other key companies like Toloka for AI data and ClickHouse for databases. So when you step back, you see the bigger picture. This is really a diversified bet on the whole AI ecosystem. Okay, so that's the business. The next logical question is, how does this all translate into actual money? Let's dive into the numbers, starting with that explosive revenue. And the numbers here are, well, they're pretty staggering. In the third quarter of 2025, Nebius pulled in $146 million in revenue. Now, compare that to the same quarter just 1 year before. They were at $32 million. You do the math. That is a 355% jump year over year. Folks, this isn't just growth. This is what you call hypergrowth. But as we all know, that kind of explosive growth almost always comes at a steep price. So now we have to flip the coin and look at the other side of the income statement, profitability, or maybe the lack thereof. And yep, here it is. This slide really tells the story. While revenue just skyrocketed by 355%, their net loss also ballooned by 174%, hitting almost $120 million. And right there, that's the core dilemma for anyone looking to invest in Nebius. You've got this unbelievable growth on one side and these deepening losses on the other. So you have to ask, where is all this money going? Well, this chart is pretty revealing. If you look at their operating expenses, the single biggest piece of the pie, 36%, is something called depreciation and amortization. Now, what that really is, it's a non-cash charge that represents the cost of all those super expensive data centers and servers they're building. It's the clearest sign you can get that this company is in a massive, massive build-out phase. All right, this massive spending spree naturally leads us to our next section, the company's overall financial health. We need to take a hard look at their balance sheet and, maybe more importantly, their cash flow. And really, the key term you need to understand with Nebius right now is cash burn. It's exactly what it sounds like. The company is spending way more cash than it's bringing in, and they're doing it on purpose, pouring billions of dollars into building out their infrastructure before the demand even fully gets there. It's a classic high-stakes Silicon Valley growth strategy. So how do you pay for all that? Well, you have to go out and raise a ton of money, and they're being incredibly aggressive about it. In September 2025 alone, they raised about $4.2 billion through selling stock and convertible notes. And guess what? They're not done. They've already announced they plan to sell even more shares. This is absolutely essential if they want to keep that growth engine firing on all cylinders. Okay, so that's a snapshot of the financials today. But investing is all about the future. So where is this company headed? Let's talk about the outlook, the official guidance, and, of course, the risks that lie ahead. Well, if you ask management, they are extremely bullish. Just listen to this quote from the CEO, Arkady Volush. He's saying that because of their momentum, they're boosting their revenue outlook for the end of the year to somewhere between $900 million and $1.1 billion. To put that in perspective, they're expecting to be on track to make $1 billion a year by the time 2025 is over. That is a massive signal of confidence.
And all of this really brings us to the core debate that investors are having right now. You've got the bull case and the bear case. The bulls look at this and say, hey, they just signed massive deals with Microsoft and Meta. That proves their tech is the real deal. They see explosive growth in a market that's just getting started. But then you have the bears. They'll point to the intense competition from giants like Amazon, the crazy high cash burn, and the simple fact that trying to scale this fast is incredibly difficult and full of risk.
So, let's bring it all home. We've looked at the business, the financials, the good and the bad. What's the final verdict? What's our investment thesis here? After weighing all the evidence, our analysis comes down to one word: improving. Now, let's be clear, the risks here are very, very real. But when you look at the whole picture, the positive momentum is just too powerful to ignore right now.
And we've got three main reasons for landing on improving. First, you have to look at those landmark deals with Microsoft and Meta. Those aren't just big contracts. They are a massive stamp of approval that their technology works and that the market wants it. Second, and this is really important, we see a clear path to profitability. Now, I know the main net loss number looks scary, but if you look at a metric called adjusted EBITDA, the losses are actually shrinking fast. That metric is key because it pulls out those huge non-cash depreciation costs we talked about, giving you a better view of the actual business health. And on that basis, their core AI business is already profitable. And third, they've managed to carve out a really unique spot for themselves as one of the only new independent players that can compete at this scale.
So in the end, you can think of Nebius as being in an all-out sprint. They are spending billions and running as fast as they possibly can to build the future of AI. And the question for any investor is pretty simple, really. Are they going to reach the finish line and become a dominant force? Or are they going to burn through all that cash and run out of fuel before they even get close?